We have now looked in a lot of detail at example 8.1 and even the alternative scenarios on that, and we've touched on a lot of principles. We will now look at example 8.2 as well, and I need you to gain the following from working through this example. You need to now understand the effect on the consolidation process when your cumulative preference share dividend are in arrears. This is the focus of 8.2. The preference dividend is in arrears, and you need to see how it affects your consolidation journal entries. But when we go through this example, we're only going to focus on the differences compared to 8.1 because the principles have been established. We just need to look at different scenarios and how that would influence your consolidation journal entries. Again, always important to understand the difference between first attributing to the preference shareholders what they are entitled to, measuring their balances, and then dealing with the actual dividend declared, if any. And again, even in this example, if we do not look at every single amount in the consolidated financial statements, it remains your responsibility to do that and to be able to see how your consolidation journal entries pulls through to the consolidated financial statements. We've done that in 8.1. We've done that in example 4.1. The principles remain the same. It's only the consolidation journal entries that change depending on the given scenario. Good. So example 8.2 in Introduction to Consolidations, Chapter 8. We look at the consolidation of a subsidiary with preference share capital and if the cumulative preference dividends are in arrears. P Limited acquired a 70% interest in the ordinary shares and a 40% interest in the preference shares. The bulk of the information remains the same to make it easier to identify the differences comparing 8.1 to 8.2. My acquisition date is 1 January 29 and I'm looking at the reporting period ended 31 December 2010. Please remember the comment I've made while looking at 8.1. This period since acquisition date to the current reporting period can really be a number of years. The principles you apply remains exactly the same. All right, and in the separate trial balances of the parent and the subsidiary, we see that the parent has an investment in the subsidiary for both the ordinary and the preference shares of 120,000 and 30,000 Rand each. The equity of S includes preference share capital. The retained earnings opening balance is now a different amount. It's 147,500. Profit for the year is again 130,000 Rand of S. And now the dividend scenario is completely different. There's only a preference dividend declared and paid, and that is now for 30,000 Rand, which we will have to unpack to understand that amount. There's no ordinary dividend declared by S, only a 20,000 ordinary dividend declared by the parent. At the additional information, let's have a look at point 3 again. The preference share capital of S still consists of 100,000 Rand cumulative preference shares, and the annual fixed preference dividend is still 10 cents per share. So the annual preference dividend fixed amount is still only 10,000 Rand. Keep that in mind when you think back of the preference dividend amount declared on the trial balance of S, which was 30,000 Rand. At acquisition date, the retained earnings of S amounted to 27,500. There's a change compared to 8.1. No other reserves and the share capital has remained unchanged. Now this information is what we're going to focus on because that's where the big difference comes in compared to example 8.1. On 1 January 29, at acquisition date, this preference dividend was already in arrears for 2 years. No preference dividend was declared during the year ended 31 December 29 either. but the preference dividend for the previous 3 financial years was declared and paid during 2010, the current reporting period. The preference dividend for the 2010 financial year will only be declared at the shareholders' meeting that will be held during 2011. So there was again not a preference dividend declared for 2010. The directors of ACE Limited also proposed an ordinary dividend of 15,000 Rand for the year ended 31 December 2010, but it's only proposed. That's why there's no amount for the ordinary dividend in the trial balance yet. ACE Limited did not declare any ordinary dividends during the year ended 31 December 29, but that is obvious because if a preference dividend was not declared in 29, there could also not have been an ordinary dividend declared in 29. So what's important to gather from this paragraph is the following. At acquisition date, the X7 and X8 preference dividends are in arrears. The X9 preference dividend is also in arrears. In X10, the X7, X8, and X9 preference dividends that are in arrears are declared. But the X10 preference dividend was also not declared in X10, only in X11. Right, and we'll see the effect of that on the timeline, the analysis, and the consolidation journal entries. But it's important that you can visualize what happened with regards to this preference dividend. NCI is measured at acquisition date in the ordinary shares, now also at fair value, and the fair value of the non-controlling interest in the ordinary shares was 52,000 Rand if you read on to the next page, and the fair value of the non-controlling interest in the preference shares of ACE was 75,000 Rand at acquisition date. So both NCI in ordinary and preference shares measured at fair value. Remember, for NCI ordinary shares you have a choice, but for in NCI preference shares it must be fair value. And then it is the accounting policy of P to account for investments in subsidiary at cost in its separate financial statements.